Welcome to Mad Money. Welcome to Cramer. Other people, my friends, I'm just trying to make a little bit of money here. My job is not just to entertain, but to educate, to teach you. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. When the market flies like it's been doing, at least until today, you need to be selective. You have to get more choosy because you don't want to start your buying near the highs. And that is often a license to lose money. So on a day where the Dow tumbled 466 points, the S&P shed 0.34%, but the Nasdaq advanced 0.16%, I want to show you how a professional comes up with ideas in a tape that's roaring and does so without taking on too much risk that we have a quick downturn while attempting to get the maximum reward. You know that sometimes stock picking is all about not coming in on a stock that's already up 30 or 40% this year. Instead, you have to accept that you missed it. Not easy. I'm sure that all of you have one time or another come in on top of a monster move. Maybe a Seagate yesterday, a SanDisk earlier today, and wish you would exercise some patience because you would have been better off waiting for your pitch. And sometimes it just doesn't happen. Pass. Let's go over first the wrong way to do it. You might have decided on Monday that it was time to own an oil producer because our government now seems to be in control of Venezuela, or at least in control of its petroleum. That was a mistake, an error. You came in near the high, and more important, if Venezuela boosts its production dramatically over the next 18 months, the price of crude is going to get slaughtered. At the same time, the banks are starting to bother me. Now, look, don't be wrong. You know, this group is chronically undervalued. I have praised it many times to you. These are tremendous franchises, but we're headed into earnings season. Do you know that in 6 days, J.P. Morgan reports? I think the biggest bank, it's cheap. Stock's way too cheap, actually, 16 times earnings. So why not buy it now? I am worried short term. Because even though CEO Jamie Dimon's a fantastic banker, he's also a really cautious person. He's not going to get on his conference call and crow that his stock's undervalued. He's far more likely to talk about the potential landmines out there. Jamie is a straight shooter. There's nothing bad about that. When things look ugly, he tends to tell you what could potentially go right. When things look good, as they do now, he tends to tell you what could go wrong.
The House of Pain.
I love that. But the media will take the comments out of context and they're going to present him as an extreme pessimist who's worried about the next credit crisis. Remember his comments last quarter about the blow-up of a subprime lender, Tricolor, and the collapse of First Brands, the giant auto parts conglomerate? Both casualties within the same month of September last year. J.P. Morgan took a $170 million loss on Tricolor. Not his finest moment, although it's barely more than a rounding error for the company. Then Jamie, on the call, lowered the boom, telling us, and I'm going to quote, "I probably shouldn't say this, but when you see one cockroach, there are probably more. Everyone should be forewarned on this one," end quote. He acknowledged he was tightening his lending policies. And with that admonition, he crushed his own stock. J.P. Morgan's stock dropped from $307 to $294 in a couple of days. Many people who bought it in the 300s then dumped it. They panicked. They bought high and they sold low, and that's not what we want here. And it turns out, frankly, that there really have only been those two cockroaches. But he's a cautious man. You know what? He probably doubled down on the cockroach commentary, maybe lob a bomb or two about the future of the Federal Reserve's independence or the lack thereof. Now, that's when you want to buy after he lowers the boom, not up here after you run, even after it did get hammered today on a note of caution by an analyst. So what do? You wait for the reaction to Jamie's cautious commentary to give you a better entry point. And if it doesn't happen, pass. The amazing thing about this stock market is that it's a never-ending source of incredible ideas that can make you grow rich. Now, look, the ideas don't grow on trees, but they're readily available. You just need to know where to look. Take my morning show, Squawk on the Street. Today, my co-host Carl Quintanilla turned to me and asked what looked interesting after so many stocks had run. Now, before I go out there at 9 a.m., I always like to scrutinize the charitable trust portfolio that I run in conjunction with the CNBC Investing Club, which I wish you'd join. As I went down the list, and I literally go down company by company, I was astounded to see the stock of CrowdStrike, the best cybersecurity outfit run by George Kurtz, had fallen almost 100 points from its highs in November.
The House of Pain.
I read the most recent research and went over what George told us when he reported last time when he was on our show. I went over what NVIDIA's Jensen Huang said about the company in its keynote address in CES on Monday. Do you know that Jensen's been talking about this $10 trillion transformation, the modernization of enterprise computing via AI and accelerated computing? Do you know what he said? He said that CrowdStrike is the secure foundation of this revolution. He praised it several times. And you know what? The stock didn't do anything. I think that's wrong. So I told Carl that this is the kind of stock that rarely comes down this much and is almost never this far from its high. And when it trades like this, what do? You have to pounce. Buy. The stock was at $464 at the time, and I said it. Finished the day at just under $479. Now, they got a nice price if you bought. I'm definitely, by the way, not telling you to sell it. I'm saying that when you can get a good cost basis like you did in CrowdStrike this morning, you're playing with a very strong hand. Now, let's say we're playing gin. This is kind of like you're dealt a straight and three of a kind. And you got 2 9s with the dealer showing 6 if we're talking about blackjack. It's a terrific way to push the odds in your favor. How about Microsoft? All right, this company's been doing very well, but its stock's been punished by the fact that management wants to spend a fortune on AI. Ever since Microsoft reported its latest quarter, the stock's going pretty much straight down. How often do you get to buy the stock of Microsoft at $485 after it traded at $555 last summer? I know the answer. Not very often. I can go over how NVIDIA or Broadcom are down huge too much, and they're way away from their highs. But, well, then again, I've been recommending them consistently for club members, so there's no real revelation there. So let me give you another one that's on my radar screen that might intrigue you. One that is hated, despised. One that I wrote up in How to Make Money in Any Market as a tremendous company that's become a complicated and unloved stock because it's not tech and it doesn't have great growth. Right now, I'm talking about Procter & Gamble. The Cincinnati Colossus has seen its stock tumble remarkably from $180 in March to $138 today. This is P&G. It doesn't usually have that kind of move. It's a dividend aristocrat. Some people call it a dividend king because it's increased its payout for 69 consecutive years. You're now getting the stock with a 3% yield. I'm not calling the bottom, but it does have a new CEO who has the opportunity to shake things up. Procter's already pre-announced a nasty quarter, and it's one of the few consumer packaged good companies that doesn't have a GLP-1 problem. I got no illusions. I don't think it will necessarily stop at 3%. That's not that high a yield. Many of the packaged goods companies yield 4, 5, 6%. Those are mostly food related. How do you approach it? Okay, let's say you want to buy 100 shares tomorrow. Don't. Only buy 25 shares. Then you wait for it to fall to another level. We yield 3.25, and then you buy another 25. It gets down low to say 4%. Be extremely. That'd be a big move for that. It'd be a big dividend. Big dividend yield. Well, then you can have 50 shares. You have a very nice size position. Slowly but surely, not at one price. Okay, it's not CrowdStrike. It's not Microsoft. It's not Broadcom. It's not NVIDIA. But you can't just have all tech. The bottom line, what you really want are companies with stocks that allow you to take advantage of the magic of compounding and make longer-term gains, not trading gains, longer-term. By all means, own some unloved tech names, but save room for a quality consumer company like Procter & Gamble. It's momentarily down on slug. Fantastic franchise. Amazing dividend that can, after compounding, create great value for you and your portfolio.
House of pleasure.
Mary in California. Mary.
Hi, Jim. This is Mary from Santa Barbara.
How you doing, Mary? What's going on?
Well, I have inherited an IRA. And it's doing really great. My husband was a longtime listener and follower of you, and so everything's doing really great as expected and hoped for. But there's one stock that's a little weird, and that's AeroVironment, AVAV, and I just wonder what you think about the stock. It loses money like crazy, and then it gains money.
Okay. That's true, Mary, but I've got to tell you, you got a lucky break. After the close, we heard from President Trump said he wants to make the defense budget go up dramatically, add like $500 billion. And I got to tell you something. The stock, which went out at $318 at 4 o'clock, is trading right now at $335, and there's nothing funky about that. That's a terrific company. We have them all the time. All I can say is congratulations. Think about how much money Mary just made. Justin in Pennsylvania. Justin.
Hey, Jim, how are you doing?
I am doing well, Justin. How about you? You're from the East Coast, east part of Pennsylvania, or west?
East Coast.
All right, good. Go Birds. What's up?
So recently I've been watching Celsius closely. The stock has been getting hammered over the last 3 months, dropping from the mid 60s down to low 40s. As investors, are worried about inventory reset and integration risk.
Right.
With a price target of $70, is the current price around $50 a screening buy, or is that PE ratio still a little too rich for you? Jim?
I write this memo in the morning about 10 things I'm watching. It goes to anyone who's interested in the investing club. And I read this Needham piece. That's the one you're talking about with the price target of 70. And I thought it was a little bit aggressive, but you know what? I think it could put 10 points on because the company's doing quite well and it just closed that acquisition. And by the way, I always welcome Celsius on the show. They tell a great story. All right, listen, by all means, own some unloved tech names if you want to. But what we really want are the stocks that give you tremendous long-term capital gains. Well, remember tonight, as we head into the new year, I'm taking stock of some of the buzziest IPOs in 2025 and seeing where they are right these days. And it's not that great a story. But then there's plenty of potential new names in store for 2026, and they could be huge. I'm going to give you the rundown of the ones I'm watching and how to play them. And with all the uncertainty surrounding oil companies in Venezuela and crude supply, I'm turning to the experts and getting a picture of what to do next when we speak to RBN's Rusty Brazil. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
As we kick off 2026, I keep telling you that this will be a big year for banking with a ton of M&A deals and IPOs. And that's a natural consequence of having new regulators who, I don't know, let's just call them much more business friendly than the previous administration. At the same time, there's a real backlog of privately held companies that need to come public. They got to raise money. So tonight I want to walk you through what's happening in the IPO market, starting with last year and then getting into my predictions for this year after the break. Now, in 2025, we saw 202 IPOs that collectively raised $44 billion. That's up from 150 deals in 2024 that raised just $30 billion. Keep in mind that's still down big from the last IPO boom in 2021, when we had nearly 400 deals that raised over $142 billion. Of course, most of those deals were small. Now, only 80 of last year's offerings raised $50 million or more. Only 26 raised over $500 million. That's very tiny. In terms of performance, call it a mixed bag. Overall, only 78 of the 202 stocks that came public last year are trading above the level where they came public. That's less than 40%, not so hot. On average, IPOs from the class of 2025 are up just 5%. Although that's largely because of some big winners skewing the numbers. You know what? If you looked at the median deal from last year, they're down 15%. If you zero in on the 26 largest deals of the year, the companies that raised over $500 million, the results are still far from great. Only 12 of these 26 stocks are up from where they came public. Median performers down 6%. That said, there's a pretty wide range here. You've got newly public stocks like Karman Space and Defense, more than quadrupling from the IPO price. These guys build components for rockets and missiles. This market loves rockets and missiles. And then you got the hideous losers like Venture Global, a snake-bitten builder of liquefied natural gas export facilities that's down an astounding 73%. Do you know that was the second largest IPO of the year? Really hurt a lot of people. It's turned into a real horror show. Looking at just the 10 largest deals of the year, you know what? They're pretty underwhelming, too. Half of those stocks are trading below their offer price. And even if we look at the winners, still not that impressive. All right, let's start with Circle Internet Group. Let me explain how this works. This is a stable coin issuer. On paper, this one's a standout. It's up 160% from where it came public. But Circle's IPO priced at $31, and then it opened at $69, then zoomed all the way to $299 in less than 3 weeks after it came public. Ever since, the stock's practically been in free fall. Now it's back to $80 and change. So sure, yes, it's a big win if you got in on the IPO. Very few people did. But unless you did, well, you know what? You're down big in this. Big. Now, you know what? I can say the same thing about one that I talked about a lot on the show, CoreWeave. That's a data center operator. Came public at $40. shot up to $187 in June, only to sink to $77 today. It's up 93% from the IPO price, but down 59% from its highs. How about Figma, that's a design software play? It's up 13% from where it came public, which looks pretty good, right? But the stock's fallen 74% from its high on its second day of trading in early August. How about Bullish? Now, this is a cryptocurrency exchange. Priced its IPO at $39, then saw its stock open at $90. Now it's back down to $39 and change. Even if you got in on the deal, you know what? You barely have a gain at this point. So it's fair to say the performance of the IPO class of 2025 was pretty lackluster. And you know what? I think that's actually a huge positive for the broader stock market. At times last year, the IPO market looked like it was boiling over, driven by irrational exuberance. Yet it keeps self-correcting and returning to more rational ground. That's so good. Now, I've talked about this a lot. Back when CoreWeave came public at $40 in March, I was one of the few commentators who was willing to go positive on it. That was in the run-up to Liberation Day. And remember those tariffs? And everybody on Wall Street was terrified. I thought CoreWeave had a great business mining data. They kind of create the data center infrastructure, and the stock was way too cheap at these levels. But when it more than quadrupled by June, and then Circle Internet came public, more than tripling in its first few days, I said you had to cool your jets. Good call. Of course, Circle proceeded to surge from $115 at the time to just under $300 over the next couple of weeks. CoreWeave added another 25 points or so. But if you sold when I went negative, you still would have avoided some massive losses down the road. Maybe that's the key. Remember, when Figma came public at the end of July and more than tripled right out of the box, I tore up a box of Fig Newtons on air because the IPO market had gotten so insane. With the stock round tripping back to $37, clearly those cookies had it coming. Never like Fig Newtons. Let's not forget Fermi, which came public at the beginning of October on the heels of some of the most speculative AI-related trading of the year. Fermi's more of a business plan than a business. They plan to build a massive data center in Texas, along with their own power generation, including, of course, something that everybody loves, a nuclear reactor, eventually. Neat plan. But I almost lost my mind when the market bestowed this thing a $19 billion valuation right out of the gate. Like I said at the time, no business plan is worth $19 billion. Fermi was at $32 back then. Now it's at under $10. I hope you dodged that bullet. But again, the fact that the IPO market was able to mostly self-correct in these situations and stamp out the froth, that's what we really like, is a good thing for stocks in general. Just after Fermi came public, the IPO market went quiet for a while thanks to the government shutdown. That forced a much-needed cooling-off period for the IPO market. It was good for us. After the government reopened, we ended up getting the largest deal in 4 years. When Medline came public. Now, this is a medical supplies distributor and a medical device maker, highly thought of in the industry. Medline priced its IPO at $29, and the stock jumped to $41 on its first day of trading. Now it's just at $40 and change. Now, this seems pretty healthy to me. And it's a terrific company, and if the stock comes in, it's a buy. Here's the bottom line. All of these fizzled IPOs feel like a pretty good sign considering what we have coming for the IPO market in 2026. But that's what we in the television industry call a tease. Let us take a quick break, and when I come back, I'll get into what to expect from the IPO market this year, as 2026 is shaping up to be the year of the mega IPO. Net Money's back after the break.
Coming up, Cramer's taking a peek at what could be an historic set of IPOs on their way in 2026 and sharing how excited he is for each. Next.
Now that we're in 2026, what does the IPO market look like? Right now, we've got this sizable backlog of deals lined up from the government shutdown, including a cancer-focused biotech company called Actis that's coming public this week. But like I told you before the break, I'm thinking this will be the year of the mega deal because there are a lot of huge potential IPOs waiting in the wings. Specifically, there are 4 possible mega deals we got to cover. I think they're all worth watching. Now, the first one is Databricks. That's an enterprise software company for data storage and analytics tools. Now, we've had the co-founder and CEO, Ali Goatsio, on the show. And I've got to tell you, the few times that he's been on, tells a really impressive story. Even as this has not been a great moment for enterprise software. Goatsio's a good man, and I think this one's going to be a big success. Plus, Databricks has been having no trouble raising capital in the markets at all. Just last month, the company raised $4 billion in a Series L investment round, led by some big-name venture capitalists. That deal valued the company at $134 billion. Companies basically saw Snowflake competitor, and when Snowflake came public just over 5 years ago, everyone gawked when the company's market cap instantly shot to $70 billion on the first day of trading. By the way, while Snowflake did pretty well last year, up 42%, a real standout in the enterprise software space, its market cap currently sits a little below $80 billion, not too far above where it closed on its first day of trading in September 2020. A lot of irrational exuberance then. Food for thought. All that said, last month, the CEO of Databricks told CNBC that the latest fundraising round doesn't necessarily take a 2026 IPO off the table. As long as the IPO market stays relatively robust, these guys might be willing to come public, probably in the second half of the year. I kind of like it if it's priced correctly. How about the next potential mega deal? Now, this one's really exciting. It's Elon Musk's SpaceX. It's built an excellent business with 4 higher rocket launches. After investing billions of dollars to build its own constellation of low Earth orbit satellites, SpaceX also has a very attractive business with its Starlink satellite internet service that can connect with incredibly remote locations. It's fast, it's cheap, and it works in many places around the globe. Obviously, this one will have a ton of interest because, well, Musk's justifiably a cult of personality, right? But honestly, the real question here is what that IPO might look like, because we simply haven't seen such large private companies come public before. It's an anomaly. In December, SpaceX was valued at $800 billion in a secondary share sale process. And that's when Musk hinted that an IPO might be in the cards this year. But that $800 billion valuation represents a major increase in just a short period of time. Consider this. When SpaceX did a secondary share sale last July, the company's valued at $400 billion. In December 2024, $350 billion. June of 2024, $210 billion. And the last real fundraising round in early 2023 valued the company at $137 billion. That's a staggering gain. We don't have an in-depth view of the company's financials yet, though it looks like SpaceX is on track to generate $22 to $24 billion in revenue in 2026. Is that enough to support an $800 billion valuation, though? And how much stock would SpaceX even offer as part of its IPO? Will it be something like Alibaba's $25 billion offering back in 2014, which, by the way, only valued the Chinese e-commerce company at something like $230 billion? If it's much larger than that, will there be enough buyers to sop up the supply? I got no idea. I hear great things about profitability. I really do. But we have to wait and see before we're sure. I hate to be so wishy-washy, but I can't say more than that. Next up, there are 2 AI companies that are rumored to be IPO candidates this year. First, Anthropic. That's the parent company of Claude and OpenAI, the guys behind ChatGPT. Let's start with this Anthropic, because about a month ago, we started seeing reports that this company is preparing to come public. While Claude doesn't have the same level of brand awareness to ChatGPT, or Google's Gemini for that matter, it's widely regarded as having some of the best technology in the business. More importantly, these guys have a clear niche. Anthropic's focused on developing AI tools for enterprise customers, businesses, which account for 80% of the company's revenue. I like that because the enterprise has a lot more use for generative AI than the consumer does. A consumer business, which is also known as a B2C, has a fickle set of clients. But a business-to-business or B2B company like Anthropic has a much better chance to grow unimpeded. It can have secular growth. It is frankly not... It's not fickle. It's just sticky. That's the word people use for business to business, sticky. There's also been some reporting that suggests Anthropic's on track to become profitable much faster than most of these companies, particularly their rivals at OpenAI. According to documents obtained by the Wall Street Journal a couple months ago, Anthropic expects to break even for the first time in 2028, whereas OpenAI is burning cash at a much higher rate and doesn't expect to turn profit until 2030. We also heard that Anthropic was expected to have about $4 billion in revenue last year, which should grow to north of $10 billion this year. I like that. Buy. In terms of valuation, though, all right, now here it gets tougher. There's some pretty substantial numbers being thrown around for Anthropic. In mid-November, Anthropic raised $15 billion combined from NVIDIA and Microsoft. It's part of a broader partnership, which also includes the purchase of chips from NVIDIA and a $30 billion worth of computing capacity from Microsoft. Then just today, the Wall Street Journal reported that Anthropic plans to raise another $10 billion from some big-name investors at a valuation of now around $350 billion. Now, that's up from $183 billion the last time these guys raised money in just September. I got to tell you, I really like Anthropic as a business. Smartest people I know in tech are big believers in this one. But, man, $350 billion, that's a monster valuation. At that level, the stock will be trading at 30 to 40 times this year's sales. Not earnings, sales. And finally, there's the $830 billion gorilla that is OpenAI, which is also rumored to be a 2026 IPO candidate, though I'm not as convinced that this one can or will happen. Right now, OpenAI is apparently seeking to raise $100 billion from private investors at an $830 billion valuation. And if they can do that, you see, they won't need the money. They don't need to come public anytime soon. Hey, by the way, to put that number in perspective, when SoftBank agreed to invest $40 billion in OpenAI last spring, the deal valued the company at $350 billion. Jeez, these are staggering. Now, back in November at WSJ Tech Conference, CFO Sarah Fryer said that an IPO was not in the cards, at least near term. So I've been surprised to hear OpenAI mentioned so frequently as one of the potential mega deals of 2026 in recent weeks. Like I've mentioned before, this company's made something like $1.4 trillion in spending commitments. And a lot of people started to wonder if they could actually come up with that money, even if OpenAI can hit its ambitious long-term revenue targets. So if OpenAI were to come public this year, it would be forced to open the kimono and show us its financial results. And I bet we see huge operating losses and a massive cash burn rate. I don't think Wall Street would be too thrilled with that. Maybe I'm wrong, but that's my gut feeling. I believe OpenAI would be much better off raising a big chunk of money privately from venture capitalists instead. It's not just a search tool. It's not just a simple chatbot. It's much better than that. So I don't want to denigrate it, but just understand they're losing a lot of money. Here's the bottom line. This year, we've got the potential for as many as 4 mega IPOs that could be larger than anything we've ever seen. I don't know how the market's going to handle it. I'm more optimistic on some of these than others. But even if one of them happens, it'll be a huge deal. And if priced right, the first or second mega deal is the one you want to get a piece of. Any later than that, and this market might begin to run out of money. Sounds strange? Stick around, and I'm going to tell you why. Let's take some calls. Let's start with Tyler in Nevada. Tyler.
Hey, Jim. I hope you're doing well. I'm looking at this one as a speculative pick. It's down about 50% from its highs last year. I'm wondering if it's a buy soon or what's going on with it. It is Roblox.
Okay, now this company is a very, very good company that people decided to pay too much for. In other words, because it's losing money, this market no longer wants it. Remember what I said, last year was the year of magical investing. That year's over. If you're losing money, people don't want to touch it. That said, Dave Baszucki does a good job running it. I wouldn't mind a speculative position only on Roblox. Right, this year could bring us 4 mega IPOs that are much larger than anything we've ever seen. If even one of them happens, it's going to be a huge deal for the stock market. Much more Mad Money. I'm digging into the developing situation around oil exports out of Venezuela, helping you understand what's at stake really for the oil companies and their stocks. When I sit down with RBN Energy's Rusty Brazil, the go-to name in the business, then everyone's looking forward to a wave of new stocks to sink our teeth in 2026, like I just went over. But there could be a downside to all that new availability. And I'm explaining what it is, and it's not pretty. And of course, all your calls, rapid fire, tonight's edition of the Lightning Round. So stay with Cramer. Well, you know what's the biggest story is around here these days. What's next for the oil market now that our government has captured the president of Venezuela? This is the country which some say has the largest oil reserves on Earth, even if most of it is heavy crude. And the Trump administration wants to fix up its infrastructure and effectively manage the sale of Venezuelan oil. Now, this would be very compelling if oil were expensive right now, but what's the impact that light sweet crude's trading at $56 a barrel, and this stuff is not nearly as good? Let's take a closer look with our go-to energy expert, Rusty Brazil. He's the founder and executive chairman of RBN Energy. He's got the best data that I know. Rusty, welcome back to Mad Money.
Well, good to see you again, Jim. Appreciate being back.
Oh, I'm so glad you're here, Rusty, because first, I need you to just give us the lay of the land, because, look, the rap is biggest oil producer, conceivably the reserves are great, could really change things. But when I read your stuff, I think that may be too exuberant.
Well, it is, Jim. They have, at least on paper, a lot of reserves, more reserves than any other country in the world. But in terms of production, it's only about 900,000 barrels a day, which is tiny. And that is down from like 3 or 4 million barrels a day a few years ago. So production is down. Their volumes are going either to China or to the United States or to a few other countries. And so in the big scheme of life, we're really not talking about that much crude, like a percent or so of the world production.
Wow. Okay, now let's talk about refining. From what I read, the concept of them having a huge infrastructure refining that works is just plain wrong.
It's plain wrong. So they had at one time a huge infrastructure that works. Now the majority of that infrastructure does not work. And so they're importing more product from the United States than was going to the United States from Venezuela. So the situation is totally flipped, and it will take a long time, if ever, to see that refinery capacity come back online. We expect that when the billions of dollars start flowing from the United States to Venezuela, we think the majority of it's going to flow to upstream, not to downstream.
Okay, so let's explain that. That means we're going to get crude. This is not the kind of crude that is necessarily the most. We're not going to fill up necessarily our gas tanks with this. Explain how difficult it is to use this kind of crude versus, say, the other kinds that we have. But maybe we have a refining edge because we're ready to take oil up from the Canadian tar sands, which could be similar.
It is similar. So, this is not the same kind of thing that you see on Landman where you see gushers and it looks like a black liquid. This stuff looks like tar or maybe black molasses. And it comes out of the ground. It's got a high sulfur content, which means it's very hard to handle. And once you get it out of the ground, you either have to put it through an upgrader, which is like a simple refinery, to make it into a real crude oil, or you have to mix it up with diluent, which you can think of as like a paint thinner. So that you have to go through that entire process just to get it to one of their refineries, which is not hardly working like 20% or so, or get it to a ship where it can be exported to somebody else like the United States or China that has the refinery capacity to be able to use it.
Okay, now China's been the recipient, and of course, the Venezuelans owe China a lot of money, and they've been China's been taking it back in crude. But I understand that this crude really isn't necessarily even ending up in gas tanks there.
Well, I really don't know that. In terms of the last couple of months, it doesn't look like there's been a lot of Venezuela crude moving to China. But certainly before 2 months ago, there was a lot of Venezuela crude moving to China. So if Venezuela total production is about 900,000 barrels a day, about 140 has been coming to the United States via Chevron, and a couple hundred have been staying in country for the refineries there. And for a while, the rest was pretty much moving to China. That's not been the case, again, over the last 6 weeks or so.
No, if you look at opportunity, I know we don't pick stocks here when we talk with you, but there are refiners that had a vision that one day this is the kind of crude we would be using. They could have a possibility of making some money if we switched all that 900,000 barrels to the United States.
That's exactly right. But, Jim, it wasn't a vision. That was the plan back 10, 15 years ago. The idea was that a lot of Venezuela crude was going to come to the United States. A lot of Mexican crude was going to come to the United States. And the refiners spent billions of dollars in order to be able to run it. Then all of a sudden, the production in those countries started to drop off, and we discovered shale. And shale does not need the same kind of hardware to produce as this heavy, sticky, high sulfur crude needs to be able to be refined.
So let's put that in perspective. If people were thinking, you know what, Venezuela's got these huge reserves, more important, say, to our country than the Permian, what would you say to someone who felt that that was the case?
Well, first of all, I would say be suspicious of that 300 billion number for reserves. That is very well could be a made-up number. Oof. So we don't know how big that number is. Secondly, the Permian is right next door to a lot of refineries via pipeline that can get down to the refineries that can run it right now. And with Venezuela, you got to put this stuff on ships and bring it to the United States and then use this expensive refinery equipment to be able to run it. So in my opinion, it'll be a long, long time before it's more important to the United States than the Permian.
Well, how about this 30 to 50 million barrels that we heard talk about? Can you put that in perspective, what President Trump's talking about?
Yeah, first of all, we don't know. So let's assume that the number is 50 and not 30. Obviously, there's a big difference between the two numbers, right? So. But let's assume, let's assume it's 50. And then the question is, how long is it going to take to get that much crude from Venezuela to the United States? Oh, and the kind of ships that they'll probably likely use in order to do that, 2 or 3 months if we get the majority of the production and the inventory that's already there into the United States. So when that happens, well, that's a big deal, but it's only 300, 400,000 barrels a day. And back in the good old days, when we were running a lot of Venezuela crude, we were running 1 million barrels a day. So we can take a lot more crude oil than the 50 million that they're talking about right now.
All right. So last question, because I always like to come to you for price. If Venezuela was really able to flood the world, what would happen is these oil companies would probably be wrong spending all that money, because if they're going to get in a price where crude falls from here, it may be a bad investment.
Yeah, but Jim, I think it's going to be a long, long time before Venezuela floods the world.
Okay.
President Trump's talking about 18 months, maybe 18 months. We've got another 400, 500,000 barrels a day out of Venezuela. That is not going to flood the world. And so when we're talking about spending, tens or hundreds of billions of dollars over the course of the next few years, I think before you even have to worry about such a thing, we're probably maybe a decade out.
All right. Well, I'm going to.
So I think that's very unlikely.
Keep the speculation of landmen. Then I'm glad you gave us that historical reference, because that's what everyone's been watching. Well, anyway, I want to thank Rusty Brazil's founder, executive chairman of RBN Energy. Rusty, thank you for coming on and telling the truth. It really makes things crystal clear. Appreciate it.
You bet. Happy to do that, Jim.
All right. Mad Money's back in. It's time for the light round. Curse back to Robert Colton, saying the stock total about the buy, sell 7 on the core. Stock question at 10. My tip is the way to play this down. And then the lightning round is over. Are you ready, Skinny Daddy? Time for the light round. Let's start with Jeff in California. Jeff.
Jimmy Chill, Happy New Year.
Right at you. Same. What's happening?
This is Jeff from Walnut Creek, California. I'm a club member.
Excellent.
My question's on Palo Alto Networks.
I think that Nikesh Arora does a great job. I slighted him too much. I said so many good things about CrowdStrike earlier. Palo Alto's terrific company is well off its high. I think it is a buy. Let's go to Randy in Washington. Randy.
Booyah, Jim. This is Randy from the small town of Rainier, Washington. This company had the best performing system stockware in 2025, the year of magical investing, but I believe this is part of the same CrowdStrike group you talked this morning on Squawk. It's down from a high of 141 in October. With deals in place for Microsoft, Meta, and the Blackwell rollout, what are your thoughts on this company in the year of practical investing?
Well, I'll tell you, a younger person came to me, asked me about stocks that were losing money the other night at the Versant launch party. And he hadn't actually mentioned Nebius. And I said to him, losing too much money. And I said, you're young, you can speculate on it. A person who's a little bit older, too much risk to it. But I blessed it for him because he's very young. Otherwise, no. The opportunities are better elsewhere. Let's go to Joe in New York. Joe.
From Long Island.
Joe,
Happy New Year, Jim.
Same to you. What's going on?
Been following you since your radio days.
Oh, my God. 25 years.
All right. You got it. And I'm older than you.
No, there's someone older than me. Check that out. When I scroll down everywhere, it always stops at 1955. There's someone older than me. Let's check that. Do a fact check that.
Well, in any case, I've been a follower of you, and I've read your books.
Thank you.
Rambus is the name of the stock. It's done well last year. I've had it for several years. Should I consider buying more?
You know, it always had great technology. It really always has. I always keep waiting for it to have like an explosive move. And by the way, thank you for those kind comments. It hasn't, but you know what? It's not that expensive versus growth rate. I'm gonna bless it for you. You've obviously done some homework, and you've been around for a long time. You know it's a good one. Let's go to Bob in Vermont. Bob.
Hi, Jim. Happy New Year.
Happy New Year, you, Bob.
I have a question about Wingstop, which seems to have a lot of short interest right now.
Well, that's because they did miss a quarter, and they didn't give you a good explanation. Since then, it's been up and down. We're struggling with Texas Roadhouse right now. Why? Because of cattle pricing. I have to tell you, the ones that I do like, though, I like Texas Roadhouse. I do like Yum. It was downgraded today. I like McDonald's. But I can't pound the tables. I told Jeff Marks from the Investing Club, my partner, I can't pound the table when we still have too high food inflation. So I'm going to have to say no to Wingstop. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, 2026 could feature the biggest IPOs of all time, but this could pose an unexpected danger to your portfolio. Cramer's sending out the warning. Next.
When I think about what could derail this market, I always come back to supply and demand. Earlier, I told you about the big IPOs that could come later this year. These deals will be exciting. New people will wade into this market like you haven't seen in ages. There'll be retail demand. I think we'll find that investors and traders will all want a piece of OpenAI or SpaceX at any price. But there's an underside to a booming IPO market that we have to talk about. These are all much larger companies that we've ever dealt with. Companies that will win billions upon billions of dollars when they come public. We're not used to that. Among Databricks, Anthropic, SpaceX, and OpenAI, we're talking about companies that are already valued at hundreds of billions of dollars. And it wouldn't shock me if a couple of them actually aim for $1 trillion valuation right out of the chute. It will be unprecedented, and it could be deadly for the rest of the stock market. Here's why. We live in a world where there's a set amount of money that individuals are willing to plow into the stock market, and that amount isn't all that big. Although if you batch all the orders at once, of course, it's a force to be reckoned with. We have mutual funds that are powerful. They'll try to get as much stock as possible in the IPO because these deals will presumably be priced as logically as possible to benefit both the buyers and the sellers. I mean it. These deals are so high profile that the bankers will try to make it so everyone wins. But the problem is, by the time these deals are priced, the allocations are divvied out, and the retail investors flood in and bid up the opening price, there may not be enough money sloshing around to handle all the stock that's for sale. I bet there'll be enough maybe for the first mega deal to roar right out of the gate. Maybe the second one, it could do well too. But if we get 3 or 4 close together, now that is a very different story. Again, the first one will be fine. With the discipline on the part of the underwriters, the second deal might work too. Meaning it'll be placed in the right hands, not flipper hands, but real investors. Go to a slight premium. However, by the time we get to the third mega deal, we're going to find out, I believe, that we're maxed out. There simply aren't hundreds of billions of dollars of non-index fund money floating around to support the prices we're liable to get. Supply, that's excess stock, will overwhelm demand, and the market will have to digest all of this new stock. Can it? I think not. And I'm worried well in advance because if we get a bunch of these deals, lots of other stocks will have to be sold so the potential buyers can raise the cash to participate in the big IPOs. Older stocks in your portfolio will get hammered because that's the only way the buyers can raise money. That's what happened in 2000. It happened again in 2014, and very few people saw it coming. And we actually saw the same thing happen at the end of 2021. There aren't that many people who remember those declines from 2000 to 2014. And how people lost fortunes because so many existing stocks had to get sold to raise money to buy these giant IPOs. And these deals that I'm talking about are much bigger than that. This shift won't happen for a while, but these mega deals are the biggest looming threat to the bull. And I want to tell you about it now so you aren't blindsided when it potentially leads us to the slaughterhouse. You now know the risk. You will be better prepared for the impact of deals, the likes of which we never thought possible. I'd like to say there's always a bull market somewhere. I promise I'd find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC or its parent company or affiliates and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.